27 cents.
Okay.
And last year it made a nickel. Point of comparison. 27 cents because we've lost money on the investment side net of our corporate costs year to date. Will be more than 100% of the earnings this year. Last year was a small percentage, 5 cents of 48 cents came from the investment bank in a horrible year across Wall Street. Next year, I think if things stay like they are now industry-wide, JB Securities should earn 30 to 40 cents kind of range. That as we redeploy our cash, that should be 50 to 60%, 50 to 65% of the overall firm's earnings.
Wow. So there
kind of range. That's pretty hot.
Yeah. So today,
that will benefit from tax reform because we're a full taxpayer.
Yeah. Sure.
So those numbers I just gave don't include a lower corporate tax.
So it's worth noting. Yeah. So you've got a stock that's valued close to your stated book value with a yield
Adjusted book.
Adjusted book.
There's two adjustments. One is for property depreciation on the office portfolio that we invested in. Hopefully going to go public in January. That'll go. The impact from that will go away if it goes public. And that's about at the end of September. That was 50 cents a share. Okay, adjustment. And then in our corporate credit business, we have general loan loss reserves that are in cash as well. That also are adjusted, and that's about 30 cents or so at the end of September. So those are the two different.
But relatively.
Yeah, it's about the same as adjusted.
Yeah. But in terms of the average stock and even the average financial stocks, look like a pretty good value with a dividend yield in the ballpark of 5%, 6%. And it's variable, maybe higher at these levels.
Yeah.
With a constructive environment now for your banking and possibly even more constructive next year, you got to feel pretty good.
Well, I've stopped feeling good about our earnings, and I'm 100% focused on our stock, which arguably maybe I should have always been, but much to my chagrin, I mean, we can't control the valuation of the company. When we went public, we were a micro cap company at the time. The public market was very bullish about our kind of company. They were selling for 25 times projected earnings. We thought we went too cheaply at 22 times projected earnings, which we earned. We beat our projection that first year, even though the market sold off and most companies didn't. But now we're at 10 or less times projected earnings, and so we can't control that. We can hopefully have better earnings over time, which we have had, but I can't do anything about the PE multiple, which is so. But I think that our stock is way too cheap, and I think that we have more of a sense of urgency in trying to figure out how to get better value over the next year or two for shareholders.
Yeah, I mean down here, takeover target from a bigger suitor, another regional player, or
it's possible. I think that time will tell.
Yeah.
So that's possible, but I think that there's other things I think that we can look at that are just things we can manage ourselves without having someone take us over at a high price. But that would be acceptable if that were to happen. I think as a public company, we're pretty well aligned with our investors. But I think that if that doesn't happen, I think there's some leverage that we can look at to drive value if the market doesn't recognize the value of the company.
Sure. Finally, I guess, in terms of the new parts of the company with your advisory business and your undeployed, CLO or capital that you're looking for opportunities, you'd have to think that those could be relatively accretive to an investor in the next year or two.
Well, you know, our CLO business right now, the deal we did in June, we think was reasonably conservative assumptions factored into the analysis. We think will earn us rough plus or minus 12% a year return. But before we put that money out, it was earning less than 1% in a money market account. And the source of the
You got
money,
1%? How'd you do
a
that?
little less, 85 basis points.
Do you really
And the
turn
source-
some risk?
No, we have a deal with our bank, so it's a little better than you could get or I could get in the money market. But the source of that money was long-term fixed rate debt at an average cost of 8%. So when we turned over our first two CLOs, they turned over from earning us a nice return funded with 8% to a money market account funded with 8%, and it has nothing to do with running a business or anything. That's just math.
Yep.
And that affected our first quarter in a big way, our second quarter in a big way, but less so than our first quarter, our third quarter in a big way, but less so than our second quarter. And, you know, as we continue to build assets there, that will get to the point by the middle of next year where we should be earning our dividend again, just from the net investment income that we earn. And that should be a driver of the value of the stock. From the standpoint of JMP Securities, it's one of the last remaining independent investment boutiques.
One of the survivors.
We've not bought anyone. Clean balance sheet, good corporate culture, highly profitable business, well-aligned employees with investors, and you know, that's a business that isn't well appreciated in the public markets now.
Sure.
But when we went public back in 2007, that's all that anyone cared about. That part of our business. And when Montgomery Securities, my former company, when we sold our business to Nations Bank along with 30 other middle market firms out of the top 50 in that 97 to 2001 period, that was all the buyers cared about. So it's unclear whether that will get valued differently, and if it does, when, but we run it very well. It's highly profitable. As I mentioned, it's going to earn over 25% this year, fully taxed, and less than 1-to-1 leverage. There isn't another company that I'm aware of out there that has that kind of profitability, and we don't have the scale that most of our competitors do. So if we can grow our business going forward, our profit metrics will get better through growth. We have a lot of fixed costs that could be leveraged through revenue growth still compared to others.
Well, Joe, thank you so much for joining us at
Thanks
our
for
conference.
having me at your conference again, and
We wish you all the
every year you
best.
look younger. I don't know what you keep doing, but you're looking good. You're an old guy. Still working every day.
So, thanks for coming.
Take care. Thank you.